Welcome to Talk Tickers, where we cut through the noise and deliver the essential insights from the most critical earnings calls. Today, we are deep diving into Workiva, that's ticker WWKA, following their Q2 2025 earnings call held back on July 31st. And if you saw the market reaction, it was massive, right? Workiva delivered a quarter that really seemed to shift the whole narrative around the stock. It wasn't just growth, it was profitable growth. You could really see strong subscription momentum and management's clear focus on disciplined margin expansion paying off.
That's absolutely right. And our mission for you today is really to synthesize those headline numbers, dig into the strategic moves management is making, particularly around things like GRC and AI, and then look at that updated guidance. Because understanding all that is key. This quarter clearly signaled, I think, an inflection point where the scale we've built is finally translating into some serious operating leverage.
Okay, let's unpack the results snapshot then, because the size of the beat was pretty significant, starting right at the top line. Total revenue came in at $215.2 million.
Right, and that's 21% growth year over year.
Which easily surpassed the consensus estimate, what was it, around $208.9 million.
Blew past it, and here's where it gets really interesting, like you said. The profitability. Non-GAAP EPS landed at $0.19.
19 cents. And the consensus was looking for just 5 cents.
5 cents, that's more than a 300% surprise on the bottom line. It's pretty dramatic.
Wow.
And even the GAAP EPS loss, it was much narrower than expected too, came in at negative $0.35 versus the estimate of around negative $0.49.
Yeah, that kind of margin performance doesn't just happen by accident. Management specifically called out that they didn't just beat the high end of the revenue guide,
right,
but they exceeded the non-GAAP operating margin guidance by a full 380 basis points.
380. That margin surprise alone tells you a lot about their internal cost discipline, and it really proves the platform's scalability.
That efficiency is the core of the news story, I think.
Exactly. So let's look deeper into that financial engine. Let's focus on the durability of their revenue base, which is, key for SaaS. Subscription revenue, that recurring lifeblood, was $198.2 million. That's growing 23% year over year.
Okay, but hold on, let me just push back a little here. Subscription revenue surged, yes, but professional services revenue was flat year over year at $17.0 million. Does that flatness maybe signal anything, like a potential bottleneck in rolling out big new implementations, or maybe even a slowing pipeline for the really large deals?
That's a fair question. Definitely something to watch. Now, while flat professional services could point to some macro headwinds impacting those massive new deployments, Workiva's take is that it's mainly due to efficiency gains from their partner ecosystem, like the Big Four helping out.
Okay.
And honestly, the huge growth in the recurring subscription revenue base at 23%, it really overshadows the flat services number.
Yeah.
Plus, we're still seeing fantastic non-GAAP gross margin at 79.1%.
79.1, yeah.
And that non-GAAP operating margin hit 3.8% for the quarter. So they seem to be successfully decoupling that high revenue growth from needing tons of professional services growth alongside it.
That strong gross margin provides the foundation. Okay, let's look at the customer metrics then, because that tells us how sticky and expansive the platform really is. Net retention rate, NRR, where did that land?
NRR was 114%.
114, wow.
Yeah, up 5 full points from 109% in the prior year quarter. And that includes only about a 1-point positive impact from FX, so it's mostly organic expansion.
And just for anyone listening who needs a quick reminder, NRR, that's basically the proof that customers are spending more money with Workiva each year, right? It shows existing customers are expanding, buying more modules.
Exactly right. It's the expansion metric. And their ability to just keep customers, that's nearly perfect too. The gross retention rate, GRR, hit 97%.
97%.
Which actually exceeded their own internal target of 96%.
Maintaining a 97% GRR while also dramatically expanding NRR like that, that's extremely efficient. That's what investors love to see.
And you see the expansion story clearly when you look at the big deals. Contracts valued over $500,000 grew 35% year over year. They now have 208 customers at that level.
208.
And contracts over $300, those grew 37% year over year.
Okay.
And it really seems driven by multi-solution adoption.
Ah.
But get this, 71% of their subscription revenue now comes from customers using multiple Workiva solutions.
71%. That's up from 67% last year.
No.
Going from 67 to 71% in just a year, that's huge for platform stickiness. It's like the definition of it. Once customers are in, they just keep adding the next module. It's like the SaaS version of the Costco effect or something.
Yeah, something like that. So moving from the numbers to the strategy on the ground, Workiva keeps winning these big platform deals across financial reporting, GRC, and sustainability. One major highlight they talked about was a 7-figure expansion deal with a Fortune 500 bank.
7 figures. Okay. What was driving that specific expansion? That sounds like a pretty critical use case.
Yeah, it was directly driven by complex compliance needs.
Right.
Specifically, it was Federal Reserve large financial institution readiness regulations.
Okay. Heavy stuff.
Very. And the key requirement was integrating climate risk modeling into their broader risk analytics structure. That really demanded Workiva's platform for unified reporting and, critically, auditability. It shows the platform moving deeper into mission-critical regulatory areas.
And we also saw that mid-6-figure new logo win with a UK asset management firm. I liked that example because it shows the platform's other value prop, consolidating tech stacks, getting rid of redundant point solutions.
Right, the efficiency play for the customer, too. And we should definitely note the role of their ecosystem here. The Big Four advisory firms, they were mentioned as playing key sourcing and delivery roles across several big deals.
That partner leverage is a real asset for them, especially getting into complex environments faster. Okay, let's talk about the sustainability solution segment. It's clearly strategic, but it's still less than 15% of total revenue. And management did mention seeing some moderation in demand there.
Yes, specifically within the corporate account segment, both in the U.S. and Europe. But the context here is important. This moderation followed a period of really, really strong momentum back in late 2024.
So it's more of a cooling off from a hot period, not necessarily a downturn.
Exactly. Management explicitly said this risk, this moderation, has been factored into their updated guidance. They're still winning deals, especially around mandated compliance like CSRD readiness in Europe and these big enterprise-wide reporting frameworks, but they're clearly managing expectations on the overall pace of growth there for now.
Got it. Okay, switching gears slightly, the competitive moat. Workiva made a point about its licensing model being solution-based, not seat-based. Why is that an advantage right now, especially with everyone talking about AI making individual workers more efficient?
Yeah, that's a great point. Management argues that the solution-based license allows for sort of unconstrained use within the organization. If you're a big company, you don't want to worry about your per-seat software costs suddenly ballooning just because generative AI is making your existing employees hyper-efficient or because you're implementing internal automation.
Right. The value shifts.
Exactly. Workiva's model is more value-based, tied to the solution outcome, which they believe is increasingly attractive compared to traditional seat-based models, especially in the age of AI.
And their internal AI strategy seems to play into that security angle, too.
Absolutely. They emphasized integrating agentic AI into the platform itself. This is really crucial because they aren't exposing sensitive customer financial or GRC data to train external large language models.
Which is paramount in regulated industries.
Paramount. Being a secure, auditable platform with AI built in, rather than bolted on using external services, is a huge persistent selling point for them in finance and GRC.
Okay, one more thing before we get to the guidance. The leadership change. CFO Jill Clint is stepping down.
Yes. Though she's staying on through December 2025 or until they appoint a successor. So it's a very long runway for the transition, which is good.
Definitely reduces disruption risk.
But still, something investors will track closely.
Okay, now for maybe the most impactful part of the call. The significantly raised guidance. This structural shift in profitability expectations, this is what really lit a fire under the stock.
No question. For the full year 2025, Workiva really boosted its outlook. Revenue guidance was raised to a range of $870 million to $873 million.
Which is a solid raise on the top line, but the real story, like we keep saying, is the operating leverage commitment.
Exactly. Non-GAAP operating margin guidance was raised to a range of 7.0% to 7.5%. That represents a commitment to a 200 basis point improvement over their prior outlook.
200 basis points. That is a clear statement that the path to scaled profitability isn't just happening, it's accelerating.
And consequently, non-GAAP EPS was also substantially raised, now expected between $1.31 and $1.38 for the full year.
Quite a jump from where estimates were before the call.
Huge jump. They also put out a forecast for free cash flow margin to be approximately 10.5%. Now, management did add the usual caution, noting the macro environment remains uncertain, deal cycles can still be elongated.
Right, the standard caveats.
Standard caveats. But they said overall performance was consistent with Q1 trends if you exclude that specific sustainability softness we discussed.
And importantly, they confirmed they haven't factored in any kind of meaningful capital markets rebound into that guide. So things like a pickup in IPOs, which Workiva often benefits from, that's all potential upside.
That conservatism, combined with that firm commitment to hitting higher margins faster, that really seemed to confirm for investors that Workiva is making the turn towards scalable profitability and durable high retention growth, hence the huge stock reaction.
Makes sense. Okay, time for our favorite segment and the all-important disclaimer first. This is not financial advice. We are not brokers. We are not investment advisors. This information is purely for informational and entertainment purposes only. Please do not trade based on anything you hear us discuss today.
Absolutely.
Yeah.
But if we were putting on our hedge fund analyst hat for a moment, pitching an outrageous but plausible trade idea based on this call, the thesis might go something like this. The market has clearly priced in a lot of that margin expansion story right now immediately after the earnings. But there's still macro uncertainty out there, and you have the CFO transition coming up, which could maybe temper the stock's velocity in the super short term.
Okay.
So the true upside might not be just the next quarter, but really in the longer term execution on that operating leverage promise, and crucially, the attachment rates of those new secure AI features as they roll out and prove their value.
So the trade philosophy is capture the long-term story.
Right. How do you monetize the market's current stability, that post-earnings floor, to buy relatively inexpensive exposure to the 18-month execution story? Well, one way, and again, purely hypothetical, might be to use very long-dated call options. Say, looking out to January 2027, maybe targeting a strike like $100. This aims to capture the full benefit of that operating leverage and AI adoption curve over the next year and a half plus.
Okay, but long-dated options can be expensive. How would you finance that?
You could potentially finance part of it by selling a shorter-dated put spread. Maybe something like selling the October 2025 $75 put and buying the $70 put. You're essentially betting that the massive rally holds the immediate floor around, say, $75, but you still give yourself some room for a pause or pullback due to macro caution or that transition risk.
So the long-term story via calls, financed by selling near-term downside protection, betting the recent pop holds.
Exactly. It's a way to try and maximize exposure to that core multi-year platform and margin growth story while using option structures to manage some of that near-term volatility or uncertainty. Outrageous, perhaps, but plausible within the framework of the call narrative.
An intriguing structure to think about, definitely. Okay, let's recap the core takeaways from this Workiva Q2 2025 deep dive for you. We saw a major, really dramatic beat on EPS. NRR showed continued strength at 114%. There was that firm commitment to a 200 basis point raise in the full-year non-GAAP operating margin guidance. And strategically, key wins in financial services and GRC, often driven by critical regulations.
And I think the key takeaway for you, our listener, is really the clarity of their commitment to efficiency now. Considering that focus on maintaining high 70s gross margins and that specific accelerated commitment to operating leverage expansion, it really raises an important question to track going forward. Just how much further can profitability scale, especially as those new AI features start to generate specific revenue proof points and really drive that multi-product attachment growth over the next year or so?
That structural efficiency and the AI contribution, that's definitely the variable worth tracking as we head towards the next quarter's results. Thank you for joining us for this in-depth look at the Workiva earnings results.